Hello, my dears. Daniela here, and welcome to another episode of the Spa Marketing Made Easy podcast. This episode is brought to you by Addo Aesthetics, the #1 coaching company for spa industry professionals wanting to step into the role of spa CEO. And today we are welcoming Marc Sheridan of Sheridan Wealth Advisors to discuss the Employee Retention Credit, or ERC, which is very important to learn about if you were open and had employees during the pandemic. So Marc is going to break down exactly what the ERC is, who qualifies, and how to get help or support in this area if you're wanting to apply. And the great thing is, if you had 10 or more W-2 employees during the pandemic, we've got a link below this episode, and you can reach out directly to Marc's company to help you navigate this process. You'll see he has helped countless spas collect money that they are entitled to, that they do not have to pay back. It's really, really incredible. Now, if you had less than 10 employees during the pandemic, but feel that you qualify for this credit, I would encourage you to reach out to your CPA to get support. All right, let me do a quick read of Marc's bio, and then we'll jump right in. Marc Sheridan founded Sheridan Wealth Advisors in 2003, and in that time has created over $200 million in additional wealth for his life insurance clients through increased benefits and premium savings. He's pioneered the U.S. trademarked forensic reviews of life insurance process, an in-depth examination of existing policies, which now extends to 8 related areas of insurance and annuities. Beyond that, Marc has helped hundreds of families realize qualitative, quality of life changing benefits that were previously unaware of, such as adding fixed rate long-term care or preventing policies from premature lapses and soaring premiums. He's known for his ability to explain the complicated intricacies of life insurance and annuities in a straightforward, easy to understand language to help clients tailor which instruments and strategies are best for them based on today's market realities. He's been an active leader in the Bal Harbour, Florida community for 40 years. In addition to the Forensic Review series, he's authored several white papers on life insurance and annuities, copywritten strategies on charitable giving, and routinely advises estate tax planners and wealth managers nationwide. It was such an honor to have him on the episode, really sharing his expertise. I fully agree that Marc does have such an ability to explain very complex issues in an easy to understand manner. So I hope that you enjoy this episode. And again, remember, if you had 10 or more W-2 employees during the pandemic, click the link and reach out to Marc's company so they can help you navigate this process. If you had less than 10 employees during this process, then reach out to your CPA and see how they can help and support you navigating the Employee Retention Credit. All right, let's go ahead and jump into this interview. All right, Marc, welcome to the Spa Marketing Made Easy podcast. This is going to be such an impactful episode for so many of our listeners. You are with Sheridan Wealth Advisors. You guys are experts on this Employee Retention Credit. I had no idea what it was. Can you kind of enlighten us on this really life-changing opportunity for so many businesses?
Sure, Danielle, and thank you for giving me the opportunity to share with you and your listeners. Happy to be of service. So the Employee Retention Credit was approved in the CARES Act with PPP, which everybody's familiar with. And I'm sure most of your listeners received 1 or 2 rounds of the PPP loans, which in most cases were forgiven. In the same CARES Act, ERC was also put into formation, but you had your choice of PPP or ERC. The whole country went for the bigger PPP loans. Then in December of 2020, the pandemic was continuing, as we now know, and Congress passed a second CARES Act that said, even if you got PPP, if you qualify for ERC, you can get ERC as well. So in 2021, many companies like ours got into advising our clients and then other clients about the benefits, which can be as much as $26,000 per full-time W-2 employee. So as you said, the benefits in total can be quite meaningful.
So Explain to me a little bit more. I know this program is run through the IRS.
It is.
This does not have to be paid back.
Correct.
Tell me a little bit about how you qualify for the retention credit.
Sure. So there's two tests. First, you have to be eligible. Let me start there. You have to have under 500 full-time W-2 employees, which I think includes most of your listeners. Mm-hmm. But that is the first rule. You have to be eligible. But once you're eligible, then the question is, how do you qualify to your point? There's two tests. There's the revenue test and there's the government order nominally impacted test. Just in short, so that any people watching or listening will have the opportunity to either tell from this podcast whether they qualify or can look into it. And if you're not sure and you have at least 10 full-time employees, then we're here to answer any of the questions that you have to help see if you qualify. But the two tests are the revenue test. So it goes as follows. Using pre-pandemic 2019 as your baseline, we'll start with 2021. In quarters 1, 2, or 3, compared to quarters 1, 2, and 3 in 2019, was your top line revenue down 20% or more? If the answer is in any one of those quarters compared to the corresponding quarter, 2021 to 2019, was down 20% or more, then you know you're eligible for ERC benefits for at least one quarter. There are up to 7 quarters that we look at, the 4 quarters of 2020 and the 3 quarters in 2021 until the program ended at the end of the third quarter. For the revenue test in 2020, it's a harder to achieve 50% decrease in any quarter compared to, the same quarter in 2019. There you go. So many companies do qualify for revenue under either or both, but then we look at the government order nominally impacted second test, because the goal is to get, as mentioned, up to that full $26,000. So if you don't qualify in one test, we look at another. Did you have a question?
Because a lot of spa owners actually increased their revenue. They got creative. They, were doing online sales and things like that. And so I know that a lot of the spa owners that I've talked to said, yeah, I talked to my CPA about that. And they said I didn't qualify because my revenue wasn't down, but they weren't familiar with the GONI rules.
Great. So, and that does apply to some professions and industries. So let's focus on government order nominally impacted. So what the IRS has said, not in the law, but subsequent 3 rounds of guidance and numerous IRS notices, that if your income was up, revenue up more than 10%, as a general rule, it's hard to argue that government orders that may have impacted your business had much of an impact, right? So let's just say, in an easy example, your revenue was up 25%, even though there may have been a government order that said you had to have social distancing, you had to wear masks, you could only have a certain number of people in your facility at one time, and other things that made you change the way you do business. You're likely not going to qualify under government order because you weren't more than nominally impacted. On the other hand, let's say your revenue was flat. You hustled. There were government orders that really had an impact on your business, whether they were federal, state, or local, and you had to do extraordinary amount of work. You may have had to hire another person. People only work part-time. There may have been, because of the pandemic, you had to do extra juggling. But when you looked at it, voila, your revenue was level, which would be a huge win and much, much better than so many other companies did in the pandemic. In that case, you may very well qualify under the government order nominally impacted, because as an owner, you say to yourself, and this is my litmus test, were there government orders, not the pandemic itself, because the pandemic impacted 100% of Americans and American businesses, but were there government orders that had more than a nominal impact? And if you say to yourself, yeah, I really do believe that we had to change our business enough, we were impacted in that way, but because of our fortitude, our hard work, our creativity, we were able to break even, make a little bit, lose a little bit, but something in that range, but not down 20%. Then in fact, you may qualify under government order. And the benefits are the same. You can get the same up to $26,000 per full-time W-2 employee, whether it's the government order nominally impacted, which you refer to as we do, GONI, or the revenue test, they get you the same amount of benefit.
Now, for businesses that, some businesses a lot of businesses had a great impact in their cost because of the PPE, the personal protective equipment, cost of gloves. We were seeing gloves at like $50 a box. Yeah. And then, as you mentioned, like hiring an additional employee to help turn over the rooms, additional sanitation, that all counts as being part of the impact, right?
Well, if it's because of a government order, then yes, it does. We still only look at the top line revenue for the revenue test, and to make sure one can qualify under the government order nominally impacted. But to the extent that there were government orders that, as you just said, Daniela, cause you to buy gloves and masks and only see certain number of clients with breaks in between, and maybe people waiting in their car and not waiting in the lobby or your waiting room because of the social distancing. Again, as a business owner, can you say to yourself with a straight face, hey, you know what? There's no question I was impacted.
Mm-hmm. Yeah. I mean, so in so many states, you weren't able to do a facial, which is what you do. And it was like nothing without a mask. So any time, like patients could come in and you could do lash lifts or you could do different things, but you can't do a facial while wearing a mask. That's a huge impact in any of those states.
And a similar profession that suffered from that same, you can't perform certain work when you're required to wear a mask, are dentists. And we've done many dental practices, exact same thing. Mm-hmm. If you can't perform because people have to wear a mask, then you're not able to provide your core service. For your audience, they may have moved more towards other services that they could provide the same clients, and then struggled through maybe 2020 until some of the orders lifted. And we see there's a correlation, not a direct line, but a correlation between quote unquote blue and red states, where there may have been more regulations and lasting longer in blue states than red states. But again, that's not always the case. And we find clients in your profession and in the dental profession in both blue and red states that have qualified, usually under GONI.
So your company, you work with larger businesses, but you are able, any spa, med spa, plastic surgeon's practice, any derm office, anything like that in the medical facility that has 10 W-2 employees or more, they can reach out to you to find out. You'll kind of help guide them through and see, is this something I qualify for?
Yes.
And if your company, how does it work if they work with you? Your company does the work and then gets a percentage, or explain that process.
Good question. So we can usually, in a 10 to 15 minute call, speaking with the owner of a business or doctor in their practice, determine if they qualify under either the revenue or the government order test. If they know coming in that their revenues weren't down, so we go straight to government order, but obviously it's our responsibility to make sure we can't go through the revenue test first for a variety of reasons. Once we qualify somebody, we send them an engagement agreement. They sign it, send it back. Then we open up a file. We send them a secure link and a list of a handful of documents, which are usually pretty easy to obtain. payroll records, revenue by quarter, PPP, loan forgiveness. There's really only four things. And then once they give that to us, usually within a week or so, we'll be able to calculate their credit. And once we do that, we usually have the most happy of clients on the other end of our Zoom or a phone call because, again, as you mentioned earlier, the amounts of money are really significant. The owner of a business, if they own 50.1% or more, if they're, let's say, the sole owner, their wages don't count for those that are listening to this, but all of the people that they employ would be eligible for that up to $26,000. So if you had at least 10 employees, you could be looking at $200,000 or $260,000 worth of ERC benefits. It comes to you as an owner in the form of income. As you said, Daniela, you don't have to pay it back. It's not a loan. And we've collected many owners' testimonials because they're just so appreciative and frequently blown away with the order of magnitude and the help that they can get, particularly if they haven't filed and they don't really know how to go about it.
And these, just to clarify, the 10 employees, is this during a specific period of time? Is this during the 2020 to 2021, they have to have 10 employees? It's not like you have 10 employees now, right?
Good question. We're really looking at 2019 and 2020 from an IRS law perspective is the 10 employees. If you have more now or less now, that's fine.
Okay. And these are W-2 employees, not contractors.
Correct. The 1099s are not eligible for ERC benefits. It may be part of a good business model, but the ERC law is providing benefits for W-2 employees.
And if someone does not have the 10 employees during that time period, where should they be going to find more information? Is this something they talk to their CPA about, or should they go to the IRS website? Where can we direct people that are not at that 10 employee mark?
Yeah, so that's a good question. I would say their CPA is probably the right place, but the CPA will probably refer them to somebody else. And the reason why I say it is the ERC program is dramatically more complex than PPP. In PPP, most of your audience went to their CPA or a local bank to help them get their PPP loan. Mm-hmm. Because there's two laws, 3 rounds of IRS guidance, as I mentioned, from the IRS, and countless notices, most CPAs, and I would say the number is 80 to 90% around the country, elected to not get involved with ERC for their clients because it was just too much work for the perceived benefit. So they're generally not going to be the ones that would say, oh, thanks for coming to me and I'll go ahead and help process this. Those CPAs that did get involved are much stronger on the revenue test, which, as you mentioned, may not apply to most of your listeners, mm-hmm. And are less conversant and knowledgeable about the government order and the impact on business, because it's not a numbers, put it in a box type of approach that is more familiar and comfortable for CPAs. They may be a good source for somebody else. I do not have the name of a friendly competitor that I can say, call this company and they would be able to handle if you're under 10. So
do a little research, and start with the CPA.
That's what I think is
from there.
You could always Google and see what comes up. If you do that, again, you're dealing with a stranger, and that would make me a little uncomfortable, but at least there would be names that would come to you. And if you saw somebody that was touting that they had done, $1 billion worth of business, you're probably comfortable. But again, I can't speak for anybody else. We do take a conservative definition of the law. We do it for a whole variety of reasons. First, I need to be able to sleep at night, and I want the owners and our clients to be able to sleep at night. There are many ERC firms that have absolutely filed for way more benefits than clients are eligible for, because you send in a amended quarterly payroll tax return, a 941X. There is no audit. You could get audited down the road, in which case you have to explain why you justified for the money. But a lot of companies, and we know this firsthand in the industry, have been overfiling because it's a way for them to make more money. You also don't want to underfile and get less than what you should really be getting. So our approach is we stay within the lines to make sure that everybody is safe. On the other hand, we're as aggressive as possible. So we know exactly where to look and how to justify claims. And if somebody is eligible, we'll make sure that that gets identified and that we take them through the process. In our case, we do all the heavy lifting. We'll provide all of the material necessary. And after a conversation or two with the owner, typically we'll send them the paperwork that they sign. They send it back. We send it to the IRS. And a key question that all of expected owners want to know is, how long does it take to get the money that I just filed for? And the answer is typically 3 to 6 months.
3 to 6 months. And they are paying income tax on that, correct? Once they,
that's right. That's why it's not a loan. They get it as income and they would pay income tax on it.
Okay, perfect. So I believe we're going to have a form below this for people that are interested in working with your company. If you are interested in working with Sheridan Wealth Advisors, fill out the form. We need to make sure that you have 10 or more employees during that 2020 time period. We'll have some questions on there. Get your contact information through the form, and then someone from Marc's company will be reaching out as long as you're a good fit. So take advantage of this. This is just one of those opportunities that you don't want to miss as a business owner, to really help you continue to grow and flourish in your business after such a challenging time that thankfully we made it through. And a lot of us made it through stronger because we had to be really creative as entrepreneurs. We had to really problem solve and pivot, which is challenging in the moment, but I think it ultimately will always make us stronger business owners, our ability to adapt. But taking advantage of this opportunity in a legal and ethical way is great for business, I believe.
Yeah, I'd say I agree with you completely. It's incumbent on every business owner to find out if you're eligible. It's not often that somebody's going to give you what could be hundreds of thousands of dollars. And yet the government's not going to call you to say, here's the money. You really got to do a little work. I know everybody is busy, but keep in mind there's a 3-year statute of limitations for filing. So as we go through 2023, every quarter that we pass eliminates a quarter that's eligible for 2020 benefits. So right now, you can get that full $26,000 per full-time W-2 employee. As we go through this year, that number will start shrinking. And as we go through next year, the program will basically stop. So we really appreciate the opportunity to share. Hopefully, we've provided some good insight and information, and wishing everybody a super successful 2023.
Well, thank you so much, Marc. I appreciate your time. I appreciate you sharing this knowledge with all of our listeners. I hope that you guys all take advantage. And yes, happy 2023.